Michael Burry ought not to need an introduction, but for some reason, whenever I choose not to preface his views or his tweets with his accomplishments, I find my comment section littered with children calling him a one-hit wonder. So let me make this very clear, he is not a one-hit wonder. Michael Burry started investing during the dot-com boom, which quickly became the dot-com bubble. Now, it would have been very easy for him to buy into Pets.com or whichever other overhyped garbage internet company was popular at the time. And Burry likely would have made a lot of money, and he would have looked like a genius, just like how NFT investors think they look today. But the good times always end, and they tend to end with a bang. The dot-com bubble popped and the markets crashed. After Burry's first year of trading, he had returned 55% after fees to his investors, while the S&P 500 was down 12%. He then went on to continue to beat the markets over the 2000s, beating the S&P 500 every year until the next crash came. This time, though, it was the big one, the housing market crash and the Great Recession, and we all know how this story ends. Burry bet big on the housing bubble and did so in pretty spectacular fashion. He tripled his money in the same year that everyone else found themselves bankrupt. Over the roughly 8 years that Burry's fund was active, the S&P 500 returned a measly 3%, but Scion Capital, Burry's fund, returned 489%. Nowadays, though, he's infamous for his Twitter account, which you will find is frequently deleted and recreated every couple of months as Burry chooses to bless us with some content. November was no different, as Burry let loose his opinions on inflation and interest rates, asset prices, Tesla and Rivian, and his view that we are in the largest bubble of all time. Today, I'm going to recount everything he said and put it all into context for you. But first, leave a like and a comment if you want to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts from my own personal portfolio. So the first thing that Burry mentioned, and in my opinion, the most important thing, is something you're no doubt tired of hearing about. It's inflation. We all know it's very high right now. We don't need Burry to tell us that. It's over 6% on the year, 0.9% last month alone, which is over 11% when annualized. Now, unsurprisingly enough, Burry is very worried about inflation, and he seems a bit annoyed about it as well, as he has been warning us all about the risk of loose monetary policy and what it would lead to over the entire course of the last 2 years. What Burry has been trying to shed light on regarding inflation is twofold, however. Firstly, he's trying to explain and spread awareness of the fact that inflation is regressive, in that it harms the poor far more than it harms the rich. And secondly, that inflation is not purely due to supply-side constraints or a surge of increasing demand from the reopening of our economies. American real wages, adjusted for inflation, are down 2.2% since January the 1st. Seems the only meaningful thing that's down this manic year. Inflation is a massively regressive tax, never forget it. Along with that, Burry showed us this graph which plots gold price over the last couple decades next to the real yield or inflation index yield of the US 5-year Treasury. Basically, this graph tells us that inflation is high, gold is rising as a result of that, and bond yields are negative in real terms. Now, I've seen a few people claim, and even a few news organizations claim, that inflation isn't regressive, that it's progressive, and that it impacts the rich far more than the poor, but this couldn't be further from the truth, and it's something Burry would like to put to bed as well. Now, the argument for this is usually something along the lines of stocks don't perform well during inflation, and it's the rich who own the most of the stocks, so it's mostly the rich who get hurt. But of course, this is wrong, it's just completely absurd, it's not true. Stocks might not perform brilliantly during times of high inflation, but they tend not to lose 5 to 10% a year in value like cash does. The rich also tend to own all kinds of different assets which go up with inflation, like real estate, which helps to protect them, and they own far more of these assets than the poor do. The real reason, though, that inflation is so regressive is because poor people can't afford to invest. They have to hold cash because they are constantly in need of said cash, and inflation erodes that cash cash away. If you are living paycheck to paycheck, having to take out payday loans if an unforeseen expense comes out, and your only asset is the cash in your pocket, and when the government prints money, they devalue that cash, pulling purchasing power away from you and giving it to them. Add on to that the fact that often, and as is the case over the last year especially, wages have not kept up with inflation and it only gets worse. If you haven't had a pay rise of over 6% this year, then you were earning less today than you were before. Burry's point that real wages have actually decreased this year is 100% true, and wages are most important to those who aren't wealthy. People who have assets, investments, or rental properties can supplement their income with the returns from those investments, but the poor just don't have that option. Inflation is a regressive tax. It does target the poor and it doesn't impact the wealthy to nearly the same degree. Now, the second thing about inflation that Burry was trying to get across was the idea that it's no longer credible to claim that inflation is just a result of increased demand after reopening our economies. Inflation, it's not just reopening anymore, folks. Not that anyone could have seen this coming. Now, along with that, Burry linked to a graph which splits inflation up to show where it is mostly coming from. You can very clearly see a spike in inflation from reopening shown by the orange bars in late 2020 and early 2021. But over the last few months, non-reopening components of inflation, the blue bars, have been rising. Inflation is not just as a result of increased demand from reopening. That much is abundantly clear. Inflation from other factors like the hugely increased money supply is starting to rise to dangerous levels, especially if this trend continues. Really though, this is about transitory inflation and whether or not these rising prices that we've seen over the last year will be met by falling prices in 2022. A few months ago, everyone at the Fed and most people in the markets firmly believed that we would see deflation that overwhelmed inflation as demand fell, below trendline figures due to the earlier spikes, but this graph that Burry showed us makes that seem very unlikely. Now, while inflation may be one of the causes of a lot of the problems we're currently seeing, the everything bubble is more of a symptom and one that Burry has made repeated attempts to explain to us. Most recently, he said the S&P 500's nominal PE ratio is 26. And Shiller's CAPE is 39.23. Neither was necessary nor sufficient, but S&P's PE was 18 before 2008's 58% crash, 20 before 1929's 80% crash. How? Earnings fell 91% in 2008 and 73% in 1929. There are two real points that Burry is making here. Firstly, that our markets are overvalued. But secondly, that even if they don't seem overvalued by certain people today, the potential crash in earnings that could be coming over the next year could change that. According to Shiller's CAPE and the S&P 500's PE ratio, the markets are expensive. When you buy a stock today, you are receiving less earnings than you would expect to get in the past. In fact, the only time which is worse than today is the peak of the dot-com bubble, which led to a monstrous market crash. Consumer sentiment is at rock bottom. It's lower than it's been for over 10 years. People's real wages have fallen by 2% this year alone. It is not unreasonable to think that consumer trends might change with this. Maybe these impacts, falling wages and rising prices, will stop people from buying the brand new iPhone or brand new shoes or even a new car. Maybe these sky-high earnings are not here to stay. Maybe they will collapse over the next year, which would drop Shiller's CAPE and the SPY's PE ratio right down, just as we saw during the Great Depression and the Great Recession. There is a bubble in the markets right now, and there are too many reasons to list them all during this video. Burry firmly believes that there is an index fund or passive investing bubble that is being driven by the huge growth in popularity of investing through platforms like Vanguard. The S&P 500 has been growing far faster than the US economy has over the last few decades. The Buffett indicator is showing that the stocks that make up the US are valued at far higher price points than they have been in the past. So many people today are investing in index funds, but these index funds don't partake in price discovery. These funds buy the biggest stocks because they are the biggest and they inflate their values even further. This creates a positive feedback loop whereby even more is invested into these super high cap stocks because they're priced so high, which causes even more to be invested in them again. Leverage in the market only makes this worse, and there's evidence to suggest that for every $1 that is invested into passive market funds, it causes the indexes as a whole to increase by $5. That means that if I put $10,000 into the markets, then the markets get $50,000 more expensive. This is not sustainable and it can't go on forever, and it's literally just one example of one of the bubbles that are present in the markets today. Burry is a firm believer that the crypto markets are in a bubble as well, but despite what certain people like Meet Kevin will tell you, he hasn't tried shorting that market because it is so ridiculously volatile and the risks far outweigh the rewards. In particular, Burry paid a little tribute to none other than Rivian, a car company that hasn't sold any cars and yet is valued at around $120 billion. More speculation than the 1920s, more overvaluation than the 1990s, more geopolitical strife than the 1970s. Players grabbing the barrel of Kyle Rittenhouse's rifle when the SEC and the Fed nod approvingly. Ignoring the somewhat strange reference to Kyle Rittenhouse there, the message seems clear. Rivian is an example of a ridiculously overvalued company and is representative of a bubble in full swing. What other justification could there possibly be for Rivian to be so expensive? Even by Rivian's own optimistic projections, the company is still grossly overvalued and will continue to be overvalued for years into the future. But people hear that Amazon has a stake in the company and they hear about electric vehicles and they see the monumental rise of Tesla over the last few years, and they don't want to miss out on what they see as the next big ride. Now, speaking of Tesla, it's not really possible for me to hold off on that any longer because once again, Burry came out swinging. Now, before we get down to what was actually said, I think it's important to provide some context and explain what really happened over the last year between Burry and Tesla. Earlier in the year, Burry bought about $10 million worth of puts on Tesla. Now, these are options contracts that give the owner the right but not the obligation to sell a stock at a certain price. Basically, if the price of the stock goes down below what we call the strike price, then the person holding those contracts makes money. And as is the nature of derivatives, leverage allows you to multiply your potential returns by huge amounts. Now, Burry bought options which covered about $500 million worth of Tesla stock, but he only paid around $10 million for those options. The way that financial reportings are made, however, led some people to believe that Burry's short position was $500 million, which is just false. It's not true. And if these people cared to spend just a couple minutes learning how options work, they would have known that. Nonetheless, Burry put about $10 million into this play back when Tesla was worth about $700 or $800 a share, and it's now sitting at above $1,000 a share. But we know that Burry exited his position sometime over the last quarter. His contracts likely lost a fair amount of their value, or they may have even expired worthless, meaning that Burry lost between 7 and 8 figures on this play. Now, don't get me wrong, that's obviously not the desired outcome, but Burry's a very wealthy man, and this was nowhere near as big a bet or a loss as many people were making out. Now, while most people would maybe stay quiet if they had been publicly embarrassed like this, Burry is not a normal person. While he is no longer actively betting against Tesla, he is just as vocal about his belief that the stock is grossly overvalued, and you've got to be lying to yourself if you claim that you can't at least see the argument that he's making. Can Tesla fall 80 or 90%? After 2000, many high flyers did. Amazon fell 95% 2 decades ago, changed its whole business, and thrived much later. Burry's making the argument that Tesla might be like Amazon, that it may well be a great business with a great future ahead of it, but that doesn't change the fact that it is grossly overvalued. Amazon fell huge amounts during the dot-com bubble, and Tesla may well find itself in a similar situation in the near future. Burry also hit out at the fact that Tesla receives huge amounts of cash in the form of subsidies from countries all over the world, and to be honest, Burry's right here. The true test is achieving that without massive government and electricity subsidies on the back of taxpayers who don't own your cars. On top of that, Burry started to point out what he sees as evidence that even Elon knows Tesla is overvalued, and that's why he started selling his shares. May 1st, 2020, Elon said that Tesla at $163 a share is too high, and he was not kidding. Let's face it, Elon borrowed against 88 million shares, sold all his mansions, moved to Texas, and is asking Bernie Sanders whether he should sell more stock. He doesn't need cash, he just wants to sell Tesla. Just think about it. Burry is making the actually valid claim that Elon legitimately thought Tesla was overvalued back when it was worth 15% of what it is today, and that he is now selling shares. Burry thinks that Elon knows Tesla is overvalued. He knows that the markets as a whole are overvalued, and he is prepared preparing himself for a downturn by selling assets. He's sold his mansions, he's selling his Tesla stock, and he seems to be looking for excuses to sell more Tesla stock. First, he told the UN that he would sell stock to fund their food security program if they just replied to his tweet explaining how he would do it. Then he created the now infamous Twitter poll that allowed us to choose whether or not he should sell to pay some capital gains tax. Then he starts asking Bernie Sanders if he should be selling more stock, seemingly begging him to say yes. While you may not agree with Burry here, it's hard to argue that there isn't at least a small chance that he's right. Elon does seem to be looking for excuses to sell Tesla stock. We now know for a fact that these shares that he has offloaded over the last week were planned months in advance, and his Twitter poll was just a way of creating some goodwill in the mainstream media. Maybe the tweet aimed at the UN's food program was a similar attempt to create a reason for him to sell his shares. Maybe he just wants the cash, maybe he just wants to live like a billionaire, buy the biggest yacht in the world and enjoy the fruits of his labor, but maybe this is all an overarching plan to prepare himself for what might be the biggest crash of our lifetime. If Tesla did drop 95% tomorrow, I wouldn't be at all surprised if Elon started buying his shares back, increasing his position, as there really isn't any evidence to suggest that Elon has lost conviction in the company that is Tesla, just maybe the valuation that it has somehow created. I know that these Burry videos are always controversial, and there are often lots of people who don't like that I make these videos. They think we should all ignore what Burry has to say as the ramblings of a madman. But even if you are Elon's biggest fan, even if your entire life savings are in Tesla stock, it is still good for you to hear what other people think, to consider their arguments based on their own merit, and ensure you have all the facts, even if some of them make you a little bit uncomfortable. At the very least, please don't ask me how many Tesla shares I've short sold in the comments, because the answer has always been and always will be 0. I will never be crazy enough to short something that defies logic like Tesla, and that's never going to change. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. If you're looking for a way to stay clued up on all the most important financial news, then consider checking out the Daily Upside, a free daily newsletter that condenses everything you need to know into a quick 5-minute read every day. Link is down below in the description. There's also a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USD Coin, which is a far higher rate than you'll get from any savings account these days. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.